Well, Saurabh Mukherjea joins us. Let's take our conversation forward with Saurabh and let's understand where he feels that this market will give opportunity and where this market is now looking slightly stretched and expensive. Saurabh, good to have you back. Thank you for joining us. Your new book is something which I plan to read this weekend. I was planning to read last week, but unfortunately was down with a little bit of cold, cough and fever. So hopefully next weekend is when I plan to read it. Having said that, Saurabh, the book is centered around a theme which you've been discussing and which we've argued in the past, that why Indian markets will be dominated by master franchises. And the more I think about it, the more it is getting evident with the way how the nature of the economy is moving. How do you see that in this recovery, the big economic recovery, what we are staring at, which is currently fueled by commodity prices and low liquidity, how will some of the master franchises evolve?
Thanks, Nikuj. Thank you. So the whole theme of the Indian market, right, over the last decade has been this whole diamonds in the dust story that we have written about in the book. Just to put some numbers around it, over the last 10 years, the Indian stock market has created $1 trillion of wealth, right? That's a big deal. But 80% of that 1 trillion, Nikunj, 80% of that 1 trillion has come from 16 stocks that you and I have probably discussed, dozens of times on this show over the last decade or so. Another way to think about it is over the last decade, today we have reached a situation in India where 10 master franchises, 10 diamonds, as I would put it, account for 95% of the nation's profits, right? 10 mega franchises, utterly dominant, technologically savvy companies account for 95% of the country's profits. So the stock market creates a lot of wealth in India. That's the good news. But for the people out there watching today thinking that they'll have a punt here and have a punt there and make money in the market, the diamonds in the dust point of view that we've articulated in the book is you have to focus on the maybe dozen and a half franchises in the country, which make a huge amount of money, which create a lot of wealth. The stock market has 6,000 stocks, but 15 to 16 companies will pretty much make all the money in the market. And I think this recovery, we're also seeing that. So whether it's in banking, where sector leaders are growing their loan books at 15, 16%, whilst the RBI is saying overall sector loan book is growing at 5%, or IT services, where giants like TCS are being able to keep attrition down to single digits, whereas everybody else is struggling to keep attrition down even to 15%. So you're seeing this story play out in India, where every sector, one or two franchises are taking away 90% of the profits, 90% of the wealth, and it's imperative that your viewers, our clients, lock into that dynamic.
So, Saurabh, if 16 companies have created lion's share of wealth and large amount of profit pool is now concentrated with 15, 20 companies, do you think those are the 16? Well, we can make it 20, some may add another 5, 25. So 15 to 25 companies will continue to create investor wealth. Is that what you are arguing?
That's right. I think there'll be some churn, obviously. So the 15 to 20 companies that delivered pretty much all the wealth in the market in the last 10 years, maybe not all 15 to 20 of them will sparkle in the next 10 years. My reckoning is the churn will be around one third of those 15 to 20 names will have a rough decade between 2020 and 2030, and there'll be 4 or 5 new names. But the core construct of the market, the core construct of the Indian market will be a clustering of value creation around superpowered franchises, strong competitive advantages, high-class corporate governance, superior use of technology. So the core construct of the market will remain that 15 to 20 names, and there might be some churn, but I think the churn will be limited, 15 to 20 names, which will drive the core of wealth creation in the market. And what our book tries to do is help people identify those. So for example, TCS and IT services, to my mind, stands head and shoulders above any other IT services company. Its core competitive advantages in the way how it recruits, trains and retrains something like 2 lakh people every year, the largest training, retraining program anywhere in the world, that allows it to keep attrition low, that allows it to grow rapidly whilst keeping wage inflation under control. 25% free cash flow compounding over the last 10, 15 years. You have in front of you a monster franchise, a world leader that all of us can benefit from by investing in.
Saurabh, you've articulated your whole template or framework beautifully in the past. So I will not get into it because viewers and your investors are aware of it. But let's start throwing in some stocks which may apply in your filter criteria but are not part of the portfolio, whatever portfolio we know in the public domain. One of them is ITC. Some would argue that it's in super franchise and it is generating cash flows and the FMCG business is not losing money. Yet the stock is cheap. Why is that? And why is that you don't own it?
Yeah. So I think that there's sort of three parts to creating wealth in our country. I've said this before, but I'll say this quickly again today, and it's in the book as well. Step one, accounting and governance has to be top class. I think ITC ticks the box there. Step two, you need to have deep competitive advantages. Unquestionably, ITC ticks the box. I think its cigarette franchise is without equal in the country, powerhouse franchise there. But step three, you need to take the surplus that the business generates and reinvest it such that the business grows at 20-25%. I think that's where they've had a bit of a challenge. The cigarette franchise generates lots of cash. I would say close to 10,000 crores of cash comes out of the powerhouse cigarette franchise that ITC has in its portfolio for the best part of a century now. But the reinvestment of that money to generate EPS compounding of around 20% has been a bit of a challenge for the company over the last decade or so, which is why it's not in Marcellus's portfolio. My reckoning is the leadership in ITC, smart people. They are aware of the problem. They're aware of the scale of the issue. And the day the company starts redeploying its, 35,000 crores of cash on the balance sheet, the day the company starts redeploying that money to generate a 20% EPS compounding machine, we'll obviously be very happy to look at that stock.
Saurabh, in your experience, if one looks at the master franchise or the champion franchise stocks which you own, whether it's Pidilite, Asian Paints, a combination of HDFC, Life, or Dr. Lab, if one is investing or if one stays invested in these stocks from now, let's say September 2021 to September 2025 or 26, 3 to 4 years, can they give a double-digit return, or at these levels we should not expect this kind of a return? While these companies may grow, what are the chances that stock prices may not grow?
A lovely question, Nikunj. So in Diamonds in the Dust, in our book, in our webinars and in our client discussions, we keep telling people, do not look at the share price. The share price will tell you nothing, right? Level of the share price will tell you nothing. The PE multiple gives you zero information on any company. The things to look at when you decide to invest, whether it's in Asian Paints, Pidilite, or indeed any other company, first off, look at return on capital. Look at the gap between return on capital and cost of capital. Typically for a champion franchise, a diamond franchise, you'll have a gap between return on capital and cost of capital of around 30%. Typically, you'll find that the majority of that money gets reinvested back into the business. So if you reinvest, say 2/3 of 30%, you're reinvesting back in the business 20% extra capital every year. It is very, very difficult then for the business not to grow at 20% odd. And if a business grows at 20% odd year after year after year, it doesn't matter whether the stock market the stock is trading at 60p or 30p. If a business grows at 20% year after year, which means the company doubles every 3.5 years, you will make double-digit returns consistently for a very long time. And it's a very simple philosophy. We have tried to articulate it as best as we can. And we've tried to tell people, do not look at PE multiples. They will tell you nothing about whether you'll make money from a stock or not. If you want to look at numbers, look at return on capital, look at free cash flow and the reinvestment of the same, and you'll have a pretty good idea whether you'll make double-digit returns or not.
Good morning, Saurabh. I have read a few of the excerpts. I was reading mostly about Nestle, but there was a recurring theme as well, and that is when you're saying that don't look at the share price. The other thing that you make your case for is don't try to time the compounders. Can you tell us a bit more about that?
Sure. So I think linked to this theme about not looking at PE multiples, what we have shown in chapter 6 of the book is, and in fact, even I was stunned by this. We've shown that suppose you or I had perfect foresight and we bought a champion compounder like Asian Paints at the year's low every year for the last 10 years. Had we done so, Nayantara, we would have compounded at around 27-28%. Great outcome. You and I are perfect market timers. We get the year's low on Asian Paints. But suppose we're not that clever and we mechanically buy Asian Paints every year on a random date. Say 1st Jan every year, you or I buy Asian Paints. We've shown that if you did that, every year buy Asian Paints on 1st Jan for 10 years in a row, you'll make around 26%. Still a very good outcome. And then, most stunningly, we found that suppose you or I buy Asian Paints at the year's high. We buy Asian Paints at the year's high 10 years in a row, we would still compound at 19%. And therefore, the point we are using to make is if you lock into a champion franchise, a master franchise, as Nikunj calls it, where the underlying business compounds at 20-25%, it doesn't matter whether you buy the year's high or the year's low, you'll compound broadly at that 20-25%. As we say in the book, as we say on your program, there's 15 to 20 such companies in the country, and everybody watching this program should be locking into these master franchises. They'll be the core, they'll be the key to wealth creation in India over the next decade.
You've also made a case that, when you look at these compounders, when you look at some of the best stocks out there, whether there's 15 or 20, they don't necessarily have to be monopolistic, even though they are the leaders. But Saurabh, we're also at this inflection point, if I may say so, where the Nifty and the Sensex will look very different 10 years from now. The primary markets are hot. The unicorns are headed to the Dalal Street. So with the texture of the market is going to change over the next decade, there'll be new compounders. How to identify those?
Sure. So I think that's a fair point. And in fact, if you look at the last 10 years, or indeed the 10 years prior to that, typically in a 10-year period, Nandara, the index churns by around 50%. So half the names of the index from a decade ago are broadly gone. If you look at the names that are broadly gone from the index, they're sort of names which was resonant and synonymous with sort of crony capitalism, which we used to have in our country on a rampant basis till say 6-7 years ago. So as you open up the economy, make it more competitive, India interlocks with the global economy more, institutional money comes into the market that much more. The old style conglomerates, the old style setup will gradually get relegated to the sidelines of the market. We've already had a fair bit of that over the last decade or so. And my reckoning is the next 10 years will be a similar story. Old style conglomerates whose core competitive advantage was having a good connectivity with the political ecosystem. Gradually, their ability to keep up with the master franchises will be lesser and lesser. And you and I will be looking at new generation companies, superior technology, superior governance, superior ability to drive growth at 20-25% coming through. And what we are seeing, and this is very encouraging, I believe, many of the unicorns actually are plays on becoming master franchises. Many of the unicorns, what they're fundamentally doing is they're consolidating and formalizing. Both things are happening together. They're consolidating and formalizing sectors of the economy which were hitherto fragmented, right? So whether it's home deliveries, whether it is grocery shopping, whether it is buying cosmetics, whether it is education, whether it is poultry, the defining signature of many of the unicorns is consolidation and formalization. That doesn't mean all of them will make money, but I think there's a good reason. There are good reasons to believe that what InfoEdge has done through Naukri.com over the last 10-15 years, I think there's good reason to believe we will see a few more InfoEdges coming through over the next decade or so. And in a way, they slot in as the old style conglomerates gradually get pushed out of the index.
Saurabh, what is the right way then to understand some of these platform and unicorn companies? One side is this whole proposition that they are exciting and high growth businesses. Second side is that you'll have to take a leap of faith and assume that they may not be very profitable. It's a new economy which is getting created. I mean, we can be in denial mode, but the importance of tech in our life is increasing and will only increase. So what should an investor do now? Get excited about the Zomatos and the policy bazaars of the world, or say that, boss, ye difficult hai, it's a different market. I will stick to what Saurabh Mukherjea does, which is buy Pidilite, Asian Paints, and perhaps Dr. Pathlab.
I think two levels to answer that question, Nikunj. I think the first level is, I think the kind of skepticism and pessimism that I see in our country, and I've seen in our country over the last 2-3 years about the recovery. Hopefully people will now believe me that that's no longer warranted. You just have to go 50 kilometers out of Mumbai, go to the district towns in Maharashtra, see the markets buzzing, see construction materials industry, the real estate sector buzzing in small towns in Maharashtra, go to the export zones in our country and see how China plus one is leading to a massive export boom. So first point, I think for people to realize is we are in the early stages of what looks like at least a 2-year, potentially a 4-year economic takeoff driven by China plus one, driven by the lowest cost of money ever seen in our country, and driven by what so far appears to be a constructive policy set up where needless obstacles to growth are not being created by the powers that be. Now, the second level is amongst the new generation franchises that I was highlighting in response to Nayantara's question. Amongst the new generation franchises, some of them are already generating free cash flow. Some of them aren't, right? I would submit to your viewers that stay away from franchises which do not generate free cash flow, right? Neither you nor I are venture capitalists. We need to look for companies which can put on the table cash generated from a business. However good the business is, if it's not making money, I would submit to your viewers, stay away. Some of the consumer tech franchises are generating lots of cash flow. Those IPOs will come. Be patient, wait for them. Don't get excited about getting pulled into the hottest tech IPO just because the marketing around it is very sexy.
When pandemic broke out, Saurabh, you were one amongst the few who said, look, it's time to buy the new India because America is in a recession, and typically when US is in recession, it's good for India. Right now, US is not in recession. How does the equation change now? Because when the pandemic broke out, the global economy was in recession, things were different. Am I getting it wrong, or that's the theory which is not working right now?
So in fact, Nikunj, I remember I was actually on your show. It was 12th or 13th March 2020, and the market fell gap down. And I have to sort of apologize retrospectively. When the market fell gap down, I simply couldn't contain my excitement. I had to run to meet my colleagues about how much we would buy on the back of what we felt was utterly needless panic in India. The theory that we put forward, and it is actually proven with solid facts, is whenever America goes into recession, the cost of money drops in India by around 2%, and the cost of oil, the cost of crude, drops by 50 to 80%. Right? That is what we need to trigger a recovery in our country. Obviously, once the recovery is triggered, once the American recovery is triggered on the back of cheap money and cheap oil, once the Indian recovery is triggered on the back of cheap money and cheap oil, over the next 2-3 years, America recovers, cost of money gradually edges up, cost of fuel edges up in our country as well. But the recovery has begun. Once the recovery begins, we have enough economic dynamism in our nation. Once the recovery has kick-started, we have enough economic dynamism in our nation to sustain the recovery for 2, 3, 4 years. I would love to say 4. We have supply side challenges in India, so often it is 2. But once the recovery begins, we have enough dynamism in our country to sustain it for a few years. So yes, America is no longer in recession, but it doesn't need to be. The super cheap money that COVID created last year has already kickstarted the recovery. As I was saying, just go out 150 kilometers out of Bombay, go to say a town like Boisar, 75 kilometers north, or go to Sholapur, Kolhapur, and you will see the recovery already. The economy is humming along. So it's like a starter motor. You need the spark plug to fire. The spark plug has fired in India. The economy is moving. A combination of China plus one, cheap money, in turn fueling a housing recovery, a constructive policy environment is all adding to that. And my reckoning, as I was saying, at least 2 years. If the supply side holds up for us, perhaps 4 years, we should be in a recovery. But the template is very simple. Whenever you see America in recession, folks, that's the time to get very constructive on the Indian economy.
Well, the March instance which you mentioned was when markets were frozen down, and you said we've been waiting for this day, sitting on cash, and we will buy in tons HDFC Bank and Kotak Mahindra Bank. I don't know if you bought it or not, but yes, in hindsight, that was a great day. So before we wrap, Saurabh, let's understand the nature of an investor. The investor will always come when markets are at its peak. And I'm sure that must be the experience at Marcellus as well, where flows must have picked up exponentially in last couple of months and weeks. So how exactly are you managing the fresh inflows? Because you have a temptation to sit on cash, manage them. It's not a mutual fund NAV where you get a fixed NAV based on the portfolio. So Assuming that you're getting fresh inflows at the current juncture also, do you think with the master franchise portfolio which you have, you are investing them as cash comes in, or you maintaining cash levels?
I think, first off, I think we don't ever sit on cash. So if today you were to invest with us, we would deploy the money tomorrow. And that's as true now as it was, say, a year and a half ago. Secondly, we were very fortunate. We saw incredibly strong flows through the COVID, through the lockdown months into Diwali last year, and the flows, as you're rightly saying, the flows remain strong. They were very strong for us last year as well. And as the monies come in, we are deploying them immediately. There's none of this sitting on cash business, which always foxes me. Why do fund managers sit on cash? It's sort of simply beyond me. If that suggests they can time the market, which obviously is incorrect. It is not possible for rational people to time the market. What we are doing though is looking for more master franchises in niche industries. So we have a fund called Little Champs, which we stopped taking inflows last year because the flows were so strong. We stopped taking inflows into Little Champs last year. These are niche franchises, but utterly dominated by one or two companies. So we've discussed the Alkyl Amines or Fine Organics on your shows before. So what we're doing is we've launched a AIF called Rising Giants, focused more on small and mid-cap franchises who are utterly dominant market leaders in specific segments, but where the market cap is below 70,000 crores. So as more monies come in, we're obviously continuing to invest in the large cap names, HDFC Bank and Kotak Bank and so on. But we've launched this product a month or so ago with some of our own money, some of our friends and family money, where we're focused on identifying master franchises, diamonds in the dust, in the sub $10 billion, sub 70,000 crore space, because we reckon that there too, there's good chance that these businesses will compound at 25% over the next 4 or 5 years.